Welcome back to the city. This is the last episode of 5-Step Trading. By the end of this session, you will hopefully have enough tools and knowledge to start making some money in the markets. We have discussed how to generate original stock ideas. You've seen how to analyze the key drivers for a company and how to look at stock charts. And we have talked about dealing with your emotions and getting in the trading zone. Remember, it is crucial that you go through all 5 steps before you trade. Don't be tempted to miss one out. As a trader, you will inevitably lose money on some trades. Just make sure you never lose too much money. You have to stay in the game. In step 5, you're going to learn how to manage your risk and avoid putting all your eggs in one basket. Risk is an inherent part of trading. Without taking risks, you will not make much money. But you have to make sure you stay on top of the risks you take and in control of them. An essential ingredient to controlling risk is to invest only in stocks that you have thoroughly researched.
As we discussed in step 1, a lot of people tend to own stocks simply because they wrongly assume that all stocks will go up in the long term. In fact, the market can go down for years before going up again. Take a look at the following relatively recent example. If you had invested £100,000 in a typical portfolio of UK stocks in February 2007, just before the credit crisis started, you would have lost half of that during the next 2 painful years. To get back to break even, your stocks would have to go up 100%. That's a lot. Also, look at what would have happened if you had used margin. Margin means that you borrow money to invest in the stock market. Margin is great when everything is going well, but in 2007, if for every £1 you invested, you had borrowed an additional £1, then you would have lost money twice as fast, ending up with nothing. That is why you have to be very careful trading with borrowed money. The 2007 crisis examples shows that risk management is crucial, whether margin is used or not. Let's use an example to illustrate how you could decrease your risk, also known as hedge your risk, if you own £3,000 worth of Barclays Bank. We call this being long £3,000 of Barclays. In the first table, the payoff is easy to calculate. If Barclays goes up 5%, you make £150, and if it goes down 5%, you lose £150. If you want to own Barclays' position, but you're worried about the general stock market, you could hedge your risk by shorting £3,000 worth of the FTSE 100. This way you remove the general market risk, but keep the Barclays specific risk. So if Barclays drops 5%, but the stock market drops 15%, you will lose £150 on Barclays, but make £450 on your short, totaling a profit of £300. You could also hedge with another stock, as opposed to the whole market. For example, if you like Barclays relative to the other UK banks, you could, for example, sell £3,000 of Lloyds Bank as your hedge. The long Barclays versus short Lloyds is called a pair trade. Either way, you would be hedging your long position with a short position to protect your portfolio and control your risk. The profits from the short will hopefully offset the losses in Barclays. And if you're really worried about Barclays, then the best hedge is just to sell the stock itself. However, make sure you think about your hedge appropriately. It is essentially another trade. You don't want to find your long going down and your short going up. The next example is of a portfolio with 6 stocks, 3 longs and 3 shorts. The total value of the longs is £14,000 and the total value of the shorts is £8,000. The difference between the value of your long positions and the value of your short positions is called your net position. This portfolio is therefore net long £6,000.
I have a list of 10 risk management rules that I want you to follow. They are very conservative, because my goal is for you to trade for a long period and not lose all your capital soon after you have started. You can also find these rules, plus further explanations, posted on my website. Let's start with rule 1. Never be net long more than 50% of your capital. As just explained, net is the difference between your longs and your shorts and describes the overall direction of the portfolio. This rule means that if you buy stocks worth half your capital, then you have reached your limit and you can't buy more stocks unless you sell something against it. That can be the sale of an existing position, or it can be the initiation of a new short position.
Let me explain this in more detail. Say you have a total of £100,000 to invest and £60,000 of long stock ideas. So you are 60% long, which breaks rule 1. You would need to balance this £60,000 of stock with £10,000 of short investments to make sure that your net long figure is no more than £50,000 to stick to rule 1. The table shows a selection of portfolios that are allowed within the constraints of rule 1. Where the long position is larger than 50%, there is an offsetting short position to ensure that the net position is never larger than 50%. So what do you do if you're at your 50% limit and want to buy new stock? You would just have to sell something else out of your current portfolio or find a good new short idea.
Rule 2. Do not use leverage. To understand leverage, you need to understand the concept of gross exposure. Gross exposure is the value of the longs plus the shorts. Having a high gross exposure means that you have a lot of large positions, which makes your portfolio potentially very risky. So to keep risk down, I would recommend you do not use leverage.
Let's look at the example in this table, assuming again that you have £100,000 to invest. Being long £50,000 and short £50,000 gives you a net position of 0 and a gross position of £100,000. At that point, you are not leveraged. But if you are long £60,000 and short £60,000, your gross is £120,000 and you are 20% leveraged. Once the gross is over £100,000, it breaks our leverage rules.
Rule 3. Don't be net short. Net short means that the total value of your short positions is larger than the total value of your longs. If you are a longer term investor and don't want to be behind your screen following stock prices all day long, I would advise that you don't run a portfolio that is overall short. If you are an active trader, I can see situations where you would like to be short, but it's a very specific skill, so you have to be very careful.
Let's look at a few examples. This portfolio has £20,000 of longs and £20,000 of shorts. That's okay because the net is 0. However, this portfolio is £40,000 long and £60,000 short. This gives a net short of £20,000, which breaks rule 3. Let's look at a number of portfolios to see if they're breaking any of the first 3 rules. Portfolio 1 and 2 are within the rules. Portfolio 3 is more than 50% long and thus breaks rule 1. Portfolio 4 is net short, so it breaks rule 3. And portfolio 5 is leveraged and thus breaks rule 2.
Initially, my portfolio was very diversified in that it was spread quite literally all over the place, but that was really down to my inexperience as opposed to any intent on my part. But as I became more experienced, I was able to call upon my own career commercial awareness, the research tools that we'd learned about and the learning that we'd had in order to develop my portfolio to become much more sector focused. So I ended up eventually with a portfolio that was both diversified and balanced, with pairs trade amongst a number of different stocks but in related sectors.
Rule 4. Your potential profit should be 3 times larger than your potential loss.
You put up on the board, and of course it formed part of your risk discussion earlier, you don't want to lose more than 3%, you hope you'll gain 10%. Where does the 10% come from, other than the fact that it's roughly 3 times 3?
Well, you need to figure out whether what you're looking at, again, this is an art, not a science, you need to figure out whether you think the potential of making those gains is realistic or not. Because we can all invent numbers, you need to look at how the prices move, what kind of similar incidents have moved prices. Is that the magnitude of the move you'll expect? If it's not, then it's unrealistic. So you have to look for realistic opportunities. So if the realistic opportunities is going to move 5% or 3%, then if it's 3%, you would change your downside risk to 1%. So you get the 3 for 1.
If the 1% then turned out to be within the daily random
Correct.
whatever, don't do it. Don't trade.
If you would stop yourself out because of that.
That's what I meant, yes.
Exactly,
Yes.
but then, or you just lower the size. So because it's not 1% of the portfolio, it's 1% of that you've got at risk.
One of the harder things in trading is to run your winners and cut your losers. Most people take profits far too quickly. Let's see how this rule would apply to our fictional stock, Cakes for You. Say you buy 1 share of Cakes for You at 120 pence. If your target is to sell it at 150p, you would make 30p. The 3-to-1 rule means that you could risk a 10p loss in this trade, which equates to having to cut your loss as soon as the stock trades down to 110p. A stop loss is an advance order with your broker to sell a stock at a specified level in order to minimize losses. This means that in this case your stop loss would have to be at 110p. Decide your stop loss levels in advance, making sure the potential profit is 3 times the potential loss, and whatever happens, stick to them. Even if holding on for longer seems the best idea in the world, don't. Manage your risk by sticking to your original risk limits. Live to fight another day.
If you're working on a 3-to-1 risk versus reward basis, that is, you're prepared to lose 1 to make 3, you only need to win 3 times out of every 10 to make money. So this is why it's important to cut losers and run winners. If you start to run losers on the basis that it's just another day that I'll keep that position on, it'll turn around, it has to, then you'll lose a load of money, guaranteed. In effect, what you're saying to yourself is that the work that you've done before is rubbish, that you don't believe yourself now. Your mindset's changed because you've now got money on the position.
Rule 5. Size your positions according to your level of conviction, but never put more than 5% of your capital into any individual position. Putting 5% in one single stock is already very dangerous. If you did, and there is a profit warning overnight, causing the stock to open down 50%, you would lose 2.5% of your capital in one trade. That is a lot. So please stick to the 5% limits. I would suggest that in the 5-step trading method, you never put more than 5% into a single stock idea. Also, putting in less than 1% in a single stock is almost pointless. If your conviction is that low, then don't bother investing. So my suggestion is that you invest somewhere between 5% and 1% depending on your conviction.
So how does the rule to only invest according to your level of conviction affect the way you build your portfolio? Let's have a look at Cakes for You again. If you have £100,000 to invest, then Rule 5 means that the maximum individual stock position can be £5,000. With the stock trading at £1.20, this means you could buy a little over 4,000 shares. If you only have low conviction, you could invest 1% or £1,000. And if your conviction is medium, then you can invest anywhere in between 1% and 5% accordingly.
The only time I would revise this rule is if you want to invest in a stock whose price is moving around a lot, i.e. that is very volatile. In which case I would advise a limit of 3% to protect yourself, even when you have maximum conviction.
So, we have covered the first 5 of Lex's risk management rules. Setting rules is one thing, adhering to them is quite another. There is a psychological dimension to having to live with risk. Steve Ward is going to give his insights on the psychology of risk.
Traders have to make decisions under conditions of uncertainty and risk. And this, combined with the fact that they're also making financial decisions, creates an interesting and challenging situation for us as humans. Psychologically, most people prefer comfort and safety to risk-taking. Do you consider yourself a risk-taker? Do you accept that trading has a non-guaranteed probable outcome? Do you believe that you are taking a risk when you're trading? Have you accepted the possible consequences of your behaviour? To be a successful trader, you need to embrace risk, and that means answering 4 yeses. Every trade you place has a risk. It's too easy, especially when trading is going well, to focus on reward and not on risk management, which, as Lex has already outlined, is critical to your success as a trader. Alongside embracing risk generally, we must also be aware that as humans, there are factors that affect our psychology when it comes to financial risk-taking specifically. Let's look at 3 of the key ones. Let's imagine we flip a coin and we place money on the outcome. You call. We flip the coin. You're wrong. I win, you lose. Who's most likely to say double or quits? That's right, you. Now, we know from research that the majority of people, and therefore the majority of traders, become risk-averse in situations of gain and risk-seeking in situations of loss. Now, this is exactly the opposite of the behaviours required to run your profits and cut your losses, which is one of the golden rules of trading. And this is called loss aversion. Running losses and cutting profits is also affected by our desire to be right, by our ego. When we take profit too early, we confirm that we were right. We feel good. We get that feeling quickly, instant gratification. When we consider taking a loss, we have to admit that we were wrong, and that doesn't feel great. So we often keep the position open rather than take the loss and hope and wish that the market comes back. This is not a good place to be. You have to decide whether you are trading to be right or to make money. Overconfidence is another psychological factor that affects a trader's risk management. A string of winners, or particularly big win, can lead you to want to take more risk, driven by the excitement and euphoria you're feeling. So remember, embrace risk. Train yourself to run your profits and cut your losses. Trade to make money, not to be right. And notice when you're getting overconfident and pay special attention to your risk management decisions.
Let's quickly review the first 5 rules. Rule 1, never be more than 50% net long. Rule 2, never use leverage. Rule 3, don't be net short. Rule 4, your potential profit should be 3 times larger than your potential loss. And Rule 5, size your positions according to your level of conviction, but never put more than 5% of your capital into any individual position. Remember, these rules are vital to your survival in the market. So let's continue with the next 5 rules.
Rule 6. Don't put more than 10% of your capital in one single sector or theme. Investing no more than 10% in any one sector or theme protects you from too much exposure to one particular industry or theme and helps keep your portfolio diversified.
Let's see how Rule 6 applies to our fictional portfolio. Let's use Cakes for You again. Assume we put 5% or £5,000 into that stock because we had maximum conviction. Rule 6 implies that we now only have £5,000 left to invest in the rest of the food sector. This portfolio shows one of the ways in which we can do this, with £3,000 in food stock 2 and a little less in food stock 3. These 3 stocks together make our holdings in the food sector a total of £10,000, or 10% of our capital.
Rule 7. Trade at the right price. Even though most people are keen to trade as soon as they see an opportunity, this rule is meant to make you apply what you have learned and wait till you can trade at the right price. Trading and rushing are not a good mix. You have to wait for a good price to enter and exit your trades. Unless, of course, it is a stop loss, at which point you might well have to cut at a terrible price.
The company analysis and the charts modules will help you determine what the right price really is. This rule is meant to help you buy at the lower end of the PE range and at the lower end of the trading range. The converse is of course true in the case of a sell instead of a buy.
You may occasionally miss a trade by being too conservative, but more often than not, you will have another opportunity to buy or sell a stock at the level you want. Rule 8. Ensure that you have lots of different ideas in your portfolio that are uncorrelated. This is known as diversification. Rule 8 is designed to ensure that your portfolio is full of as many ideas as possible and that they are uncorrelated, not linked by one particular theme, sector or country.
The main risk of having too many correlated ideas in your portfolio is that this makes the portfolio much more prone to one particular event or theme. And that is exactly what we're trying to teach you not to do. In good times, they may all make money together, but more likely they will all lose money at the same time. So don't do it, diversify your portfolio. For instance, in million-dollar traders, quite a few traders were totally focused on the credit crisis, so their ideas became too correlated with other positions in their portfolios and the trades of other traders. Added to that, every newspaper was talking about the crisis. The credit crisis idea had become too consensus.
There's nothing wrong with taking a loss, but there's something very wrong with allowing your losses to exceed your risk limits. If you allow your losses to exceed your risk limits, you're a dangerous trader and you're going to lose money over time. You may be lucky occasionally, but over time you will definitely lose money, and you're lying to yourself if you exceed your risk limits that you set when you put the trade on. It's very important to do.
Even though the candidates in million-dollar traders did extremely well, they could have done even better by making their portfolios more diversified. That way they could have managed their risk better, been less stressed out and probably made more money. Rule 9. When you have lost 10% of your capital, you should stop trading for 1 month. This is designed to keep you in the game for the long run. Take all your money out of the market and work out what you're doing wrong. Having a stop loss limit on your overall portfolio is essential for your survival as a trader.
It is a good idea to keep a trading diary of all your trades. This means you can look back and see if and where you made mistakes in your analysis. It will keep you honest and disciplined. It should be divided into 6 parts, one for each of the 5 steps, together with the trade details and targets and stop loss levels.
Regularly taking the time to analyze your trades and what was good and what was bad about them is going to be crucial to your success as a trader. As a trader, you need the ability to reflect on your own performance and learn from your mistakes. The process of learning never stops. I myself still make many mistakes, so it's never boring. Let's build a practice portfolio with capital of £100,000 to combine with the rules we have addressed above. Assume we have the following views. Long £5,000 of cakes for you. Long £6,000 of 3 different car companies. Long £6,000 of 2 technology companies. Negative on healthcare with a short of £6,000. Positive on tobacco, being long 2%. A 2% pair trade within the mining sector. And a 2% pair trade within the oil sector. So we are long £23,000 and short £10,000. Therefore, we are net long £13,000 and our gross exposure is £33,000. We have used 33% of our capital, so we are not leveraged. No stock is more than 5% of the portfolio. If you now think the market is going up, you could buy up to £37,000 of UK market FTSE exposure before we reach our maximum long limit of 50% or £50,000. Your portfolio would then look like this. The gross would be £70,000 or 70%, i.e. no leverage. And the net would be £60,000 long minus £10,000 short, i.e. £50,000 or 50%, which is our limit. As you come up with individual stock ideas on the long side, you can sell some FTSE and put them into the individual stocks. But let's say you're worried that war will break out in the Middle East and you want to hedge your whole portfolio very quickly. What you can do then is sell your FTSE and a bit more, as seen here, to make yourself net neutral, i.e. not long and not short, but completely hedged. To do this, you would have to sell £50,000 of FTSE to end up short £23,000 to offset your long of £23,000. you are now net flat. You have no directional position in the stock market. This leads on to my 10th and final rule. Not always easy to do, yet very important. Rule 10. Run your portfolio at such a level that you can still sleep at night. I've had many sleepless nights in my career, and normally it meant that my trading had gone slightly out of control. Sometimes my positions were too big or the losses too high. So get your portfolio down to a level where you can sleep again.
It could be amazing that when you came in the morning, you looked at the screen and the screen was blue, and we'd all say, it's a blue day, as almost every company within the FTSE 100 showed gains. But then you could come in the following day and the screen would be red, and we'd say, it's a red day, as the market corrected the gains of the previous day. So I think it's important to hold your nerve and be confident in the research that you've done that's enabled you to place that trade in the first place, and sit tight and just experience the volatility of the market before the trade goes in the right direction. But equally, it's important to do your research and look back and think, have I got this wrong? And if you have got it wrong, get out of that position quickly before too much damage is done.
So let's quickly recap Lex's 10 rules to control your portfolio's risk. Rule 1. Never be net long more than 50% of your capital. Rule 2. Do not use leverage. Rule 3. Do not be net short. Rule 4. Your potential profit should be 3 times larger than your potential loss. Rule 5. Size your positions according to your level of conviction, but never put more than 5% in any individual position. Rule 6. Don't put more than 10% of your capital in one single sector or theme. Rule 7. Trade at the right price. Rule 8. Ensure that you have lots of different ideas in your portfolio that are uncorrelated. Rule 9. When you have lost 10% of your capital, you should stop trading for 1 month. And Rule 10. Run your portfolio at such a level that you can sleep at night. Knowing you have a risk management strategy in place will help you maintain the composure you need if you want to be a successful trader and investor.
We have now come to the end of the 5-step trading course. I hope that by now you have a good idea of how to go through the 5 steps, all the way from idea generation up to managing your risk. I want you to know that I spent an enormous amount of time, effort and money on this project. It's really important for me to share my knowledge in the hope that other people are able to make better investment decisions because of it. Of course, I have to use a disclaimer here. Some or all of the material used in this course might be incorrect, incomplete or unreliable, so you should not rely on this course to make any investment decisions. Unfortunately, I can't take the responsibility for any trades you might put on. They are all your own. So make sure that you always use your common sense when you trade and never risk money you can't afford to lose. I hope that this course has given you a good basis to work from. Your success as a trader is now down to you. It is not going to be easy, but I guarantee you life won't be boring either. I would like to conclude by saying happy trading and take care.